I'm Christophe Nijdam, for the one of you that don't know me. Ladies and gentlemen, first of all, welcome to our conference on confidence, ethics and incentives in the financial sector. When I co-created back in 1983 the derivative business of a then medium-sized French bank, now called HSBC France, we were confronted with the dilemma of offering such complex products to the ancestor of what became Dexia Bank. Well, we quickly decided at that time that it would have been unethical for us to do so for two reasons. The first one is that you should never sell a product to customers that do not understand it. And the second reason, you should always provide advice with the only interest of your customers first, and not of your bank as a profit center, or thinking about your own bonus. The decision was taken at the time with the entire assent of our top management. Too bad that the same institution that was a customer of ours, Dexia Bank, 20 years later had no scruples whatsoever in peddling embedded derivatives in structured loans to, among others, French municipalities and hospitals. What had changed during that period of time? Ethics and incentives. Monetary incentives went exponentially up, and ethics went in the exact same direction. Ethics used to be a system of values above the law. It became quickly equal to the law, and then it finished in the doldrums with some management quietly acquiescing to, okay, you can disrespect the law as long as you don't get caught, because if you do, you're going to be on your own. I'm delighted today to welcome a select group of delegates, which include not only policymakers, but also a very large number of civil society representatives. This is exactly why Finance Watch exists, to help rebalance the chorus so that one group of voices, that of the financial sector, does not drown out the other singers. I hope that our discussions today will thus be even more harmonious and melodic than usual. In preparing for today's event, I came across two useful little books. The first one is written in French. It was published in 2015 by Professor Paul Dębinski, who will be properly introduced later on as he is moderating our second panel this afternoon. It is called in French, Éthique et responsabilité en finance, that would translate as in ethics and accountability in finance. The second book, little book that was very helpful, it's in English, and it was written in 2007, right before the eve of the crisis. It is called All You Need to Know, not about love, but all you need to know about ethics and finance. And it was written by John Plender, which is the FT writer, and the academic Avinash Purcell. The authors wrote that a book on ethics is a risky project as it leaves one open to charges of moral superiority. I feel the same risk today in hosting this event, so let me tell you up front that while I'm extremely interested in ethics, none of us at Finance Watch can claim any special expertise in that field, and we are all here today to learn. People in finance have always faced ethical dilemmas, but they have not always behaved unethically. Understanding what makes the difference, or what makes good people do bad things, as the Archbishop of Canterbury recently put, is definitely a complicated task, but is one of profound importance for public trust in finance, and this is our topic of today. Our objectives this afternoon are twofold, as illustrated by the two expert panel we have assembled for you. The first panel will debate on restoring confidence in the financial sector. We will hear, and I hope, challenge spokespeople for three political parties on what they would like to see in the Commission's forthcoming Green Paper on retail financial services, and hear how they would protect citizens in an ever more complex financial world. Citizens are also consumers, and consumptions represent 2/3 of GDP. So if we want growth and jobs, we need to restart that main engine, not by offering more consumer debt, but by having citizens opening up their wallets again. For that, you need confidence and trust first. Public trust is indeed a vital ingredient for the financial systems to serve the economy and society. Without trust, there will be less capital for entrepreneurs and innovators. Trust is therefore a precondition for the European Commission's agenda of sustainable jobs and growth, and for our long-term prosperity, both inside and outside the financial sector. Unfortunately, trust in the financial sector has collapsed. There was a Gallup poll made in 2013, and that Gallup poll found that there was a widespread lack of public trust in EU financial institutions. In 6 EU countries, a quarter of respondents or less expressed confidence in their banks. In 24 out of the 28 member states, confidence was lower than the global average of 60%. So we do have a problem on our hands. What are the solutions? And that's the point that will be evoked with our first panel. In the second panel, we will debate the role of ethics and finance more generally. This discussion, like the first panel, will also include time for audience participation, and I hope that by the time we head for cocktails this evening, we will have a stronger grip on this very difficult topic. This very difficult topic goes way beyond the simplistic ideas and excuses we often hear, such as the view that financial scandal is caused only by a few rotten apples. Before we start, please allow me to share 5 personal thoughts with you about today's topic. First, problems that seem far removed from financial regulation, such as climate change or the refugee crisis, are far easier to tackle when people feel economically secure. The lack of trust in the financial sector is therefore a topic that concerns everyone in the EU. Second, this is more than just a PR issue. I understand that banks do not want to read about trading scandals or million-euro bonuses, but citizens also do not want to see their retirement funds eaten up in fees and poor performance, or their public services sacrificed in the wake of financial crisis. To paraphrase Forrest Gump, ethics is as ethics does. The financial sector must start putting customers and citizens first before it can expect to regain their trust. I do recognize that this is not an easy task. For instance, how to reconcile the need for competition and choice with the need for customer protection, or how to provide advice without the guidance becoming distorted by the advisor's interest. These are many difficult questions, and we will not get, of course, all the answers today. Third, as a former banker, I can confirm that we are all human. When incentives are said to be irresistible, they will not often be resisted. If these conditions lead to ethical problems, the fault lies with the system and those responsible for it, and not only with the human being doing the transaction. Our keynote speaker today, Bob Jenkins, will have more to say about the special responsibilities and accountability that apply to those at the top of the financial system. Fourth, we all know that one cannot legislate for good behavior. As Bob Diamond, the famous, the former CEO of Barclays said, culture is what people do when no one is looking. But laws and policy can do mold the environment to make ethical behavior easier. They can nudge, push, sanction, or in some cases require business models to evolve in ways that are positive for society. I firmly believe that the financial sector should not resist such moves for its own long-term good. Fifth, and this is my last point, we should realize that ethical problems in today's financial system did not arise by accident. In a famous comment about architecture, Sir Winston Churchill once said, "We shape our building, thereafter they shape us." The deregulation of finance in the 1980s and 1990s was a massive reshaping of the architecture of finance and thereafter of the people that work in it. This era saw the end of partnerships in investment banks, the rise and toleration of universal mega banks with their funding cross-subsidies, the re-engineering of trading and the privatization of market venues, the massive growth of speculative trading and of derivatives that separate risk and reward. Regulators and central banks have been dealing with the consequences of these changes for financial and economic stability ever since. On the surface, deregulation and financialization, increased competition and launched a golden period of finance. It was only later that the costs started to become apparent. In my view, any attempt to improve ethics in finance must start with where things went wrong by reshaping the building of finance. This requires hard measures, by which I mean tough regulatory and structural reform, as well as soft measures such as voluntary codes and self-regulation. The authors of my two helpful books on ethics and finance must feel some disappointment at the lack of progress in the 8 years since the crisis began. As a matter of fact, many of the scandals that have taken place either started after the beginning of the crisis or continued during the crisis. Only last year, John Plander wrote in his column in the Financial Times, "The financial system appears to have become an ethics-free zone." Warren Buffett, the legendary investor, is the one with his no-nonsense wisdom who said, "When selecting top management, you look for three qualities: intelligence, energy, and integrity. If you find only the first two, the third one will kill you. Christine Lagarde, a Director General of the IMF, reminded as recently as November 5th that the amount of legal fines for banks in the US has totaled $230 billion over the last 6 years. And she added that it represented only a mere 1.5 year profits for systemic banks. She now thinks that jail terms for bankers will be the only efficient deterrent, as fines have just become a cost of doing business. Our discussion today are a step to ensuring that integrity becomes again a proper incentive and value to rebuild confidence. Ladies and gentlemen, please enjoy this conference and give a warm welcome to our first panel.